People that are putting the work in and showing that they're taking it serious, those are the ones we like helping with the most.
Today, I had a great conversation with attorneys Adam and Paul Vincent. They are the dynamic fraternal duo behind the firm Vincent Esquire. In fact, they may be two of the most genuine people you ever meet. Their firm specializes in real estate, business, and estate planning, but as you'll see, they've definitely built a name for themselves in the real estate world. Paul and Adam have been on all sides of real estate investing, even owning their own commercial brokerage at one point. Since then, they've committed themselves to the legal side, helping structure deals and protect stakeholders. At any given time, they're helping facilitate millions of dollars of real estate transactions around the country, which includes deals of their own. It gives me great joy to welcome you to my conversation with Adam and Paul Vincent. Okay, now random question. Do you guys still run?
Is that what we're calling it? Yeah, I think we do okay. Yeah, not a lot. Not
at the same speed and not a lot.
And Paul, you were All-American, right?
He was. He won't talk about it, but yeah, he ran quickly. I was on the team. He was the start. So yeah, he ran fast.
Yeah, I did.
What was your time in the
5 miler and what'd you do? 5 and 10K in track?
Yeah, in a 5 in cross country, I ran like a 25:30, and the I got a mile down to like 4:11 or something. So
good night.
Yeah, it was good. Long time ago.
And then Adam, you were going to be like professor, right?
I got my master's in English composition. So I was teaching first year composition, the one that most college students don't like from their first year of college. So yeah, and working in the writing center. I did that for a little while. It was great. I enjoyed teaching, enjoy the classroom, but thought maybe it's not fit for a career, and took the LSAT. Paul had already been in law school and finished up, and I thought maybe a little more tangible work product in the legal profession. And so it worked out.
I really appreciate your insights and all that you offer, not just for me, because we've had some great conversations too, but what I've seen you offer other people and what I've heard from folks that I've talked to who've worked with you. When each of you looks back at the deals that you've done in the past, what deal would you say was the favorite of yours? And was it the returns? Was it the people involved? Was it the type of deal? What made it your favorite?
Adam will go first.
Oh, well, all right. I think probably some of the best deals are the most boring, I guess, in some ways. Not really boring, but some that are just they got the good numbers that work, and maybe a person who's getting a good value add that involves maybe a lot of work and gets to work in day one and is consistent, hands on. Seeing clients that do that and do the know the industry well and know the grind of it and do that. Those I think are the best kind of deals. Are the ones that are maybe less flashy, but oftentimes the ones that are best returns and the most successful for real estate owners.
Yep.
How about you, Paul?
Yeah, no, I would just piggybacking off of that. People that take it seriously because it is serious work. We see some people that are like, not so much about the details when we ask them, like, hey, what, if an investor is going to give you money, what should they expect in return? And if they don't have an answer at the stage that they're talking to us, that's concerning, right? Because that means they're just getting started, and maybe that's not the time you want to start raising a couple $1 million from strangers. So people that have the plan in place, one that makes our job a lot easier. But when someone's like, why don't you tell us what we should offer? We can't, as outsiders of the deal until we really get engaged on the raising side of it. Like, I don't know what you should offer. I don't know who your investors are, their expectations, So yeah, like Adam said, people that are putting the work in and showing that they're taking it serious, those are the ones we like helping with the most.
Now, you both have really diverse backgrounds. What made you want to go into law, and particularly real estate?
I'll say for me, I wanted to be a lawyer because famous Americans were lawyers. I didn't know anything about it. I didn't have any family in it, but I thought it was a cool trade that was kind of a good stepping stone for doing other neat things. And Adam, I'll let you chime in with that afterward. But how we got into real estate was we were at a different law firm that was doing like kind of a general practice for all sorts of different things. And we had a buddy who was running his own firm at the time and working on his own, and he had a big tax lien buyer client that needed some help in the northern part of Ohio. He was in southern Ohio, and he asked us. He had called me like a month or two earlier and was like, "Hey, I got this new client. They're buying all these tax liens. We have to run a ton of foreclosures in certain counties. Would you have any interest in helping when that time comes?" And I was like, "Oh yeah, sure." People pleasing. I had no idea what he was talking about. And then like a month later, he called and he's like, "Hey, they ended up winning this bid for about 400 or so tax liens in Summit County, Ohio. Would you want to do it?" And I was like, "Sure." And then the decision had to become like, well, do we want to make this money for the firm we're already at, or should we just decide on our own and try to run a show in a shop ourselves? And we thought about it for, I think, maybe a night, maybe 20 minutes. I'm not sure how long it was, but we ended up being like, yeah, let's try to keep this all ourselves. So from there, we saw there's all these weird real estate mechanisms for making money and for working with clients and to do all these other things. And that's just kind of what we've been hanging around ever since. So.
Yeah, no, that's great. Similarly, I was an English professor, adjunct for a little while, and thought about getting my doctorate there, but it wasn't quite what I thought it might be, and I started kind of exploring my options. The reason I went into law was partly because I saw it as two things. A, it's very diverse; it gives me a lot of options and opens some doors. I could still get back into teaching. Um, and it gave me a lot of options in terms of the type of work you can do. I was into persuasive writing, teaching that was the course I was teaching, and I always enjoyed classroom and exchanging ideas and parsing through ideas and that sort of thing. And I saw how the law was another opportunity to do that. So I liked all the options that were still open on the legal profession. I didn't really know what it was, much like my brother. I had one person in my family in the law. It was him. He was about second year out.
I'm not credible. So.
Not that helpful. The first job I had was delivering filings of the court back when you used to do that. And I was like, oh, there are 3 different courthouses in the county. So really had no idea what it was.
Rubes, absolutely.
So that was how I got into the law, and it's turned out that way. It is a great profession. It also is a profession where you can continue to help people. They call you a counselor, which is a little corny to say, but that you are an advisor and a person who's helping people solve problems, helping people with their business, and you're getting to do it in a variety of ways. So I find that very appealing and has been fulfilling that way. Yeah, and real estate's the same thing. So real estate's just kind of another version of that, where you could work with the foreclosure side. That was okay, but it's litigation and not that much fun. But real estate opens up opportunities for happy transactions. It's a business like anything else, so that's fun, and just gives you a lot of options. We got into this thing called non-performing notes. That was part of the foreclosure process, and we got involved in that, and that was kind of what opened the door to some of the creative opportunities out there in the investing and real estate world. And that's kind of what attracted us to it, was that was all the creativity and the opportunity for fulfilling work, but also interesting work.
And that's really interesting. I like how you put that, the creative opportunities there. And I'm sure you've worked with a ton of different managers. And I know for a fact you've worked with a lot of different managers with creative ideas and different incentives. But when you're meeting with managers, I know you've talked about a couple of things that make them good managers, but what do you see in managers that tend to be successful?
Yeah, for me, it is interest in doing hard work, because it is hard work. Nothing is passive. Don't rely on your property manager, because when you do that too long, the deals don't work out. So someone that's interested in the work and will do the work. And then I think just as important to that is someone that works well on a team. So it is a team sport. Commercial real estate is a team sport. You got your property manager and then all the various other helpers on the deal, whether it's, folks that are helping raise capital, folks that are, better at underwriting the deal than maybe the manager is. So that's probably the two. Curiosity is important. So like, how does stuff work? Someone that is curious about the process, curious about what the bank's looking for, responsive to the bank, making sure those deals get closed. So mean, those are the most, I think, important stuff is that. So.
Yeah, and I'll just add to that, people that are problem solvers and people that are, I don't know exactly how to put it, but that are willing to work with the other side. People who recognize it shouldn't really be adversarial, whenever possible, when it comes to either buyer and seller, sides, or as a landlord. I mean, landlords get a reputation for a reason. Those are very short-sighted landlords when it comes down to it, the ones who have the bad reputation. Ultimately, the deals that make money are the ones who, respect the property and respect their tenants. And you certainly have to have problem tenants once in a while or whatever, but that doesn't mean you have to be a bad landlord who mistreats the property, or tries to scrape every single nickel out of the deal. Doing that, I think, is actually the way to lose money on the deal, is when you let things go like that, and you get bad tenants, or you don't do good screening or whatever. Those are the ways that actually it comes back to shoot yourself in the foot. So I think people that are good at problem solving and people that are good at working with others, really, it's pretty simple, really, when it comes down to it.
Now, from the investor standpoint, if we're looking at structuring deals, what are some key things that investors really need to look at when they're working with sponsors and different real estate opportunities? What are the kinds of structural elements they should be looking into as they enter into those negotiations and really just source deals in general?
Yeah, for me, the first thing that sticks out is the LP that is expected to make future capital calls. If there's a deal that you're the LP and this GP has allegedly done the underwriting and is laying out all these metrics and pro forma goals and all that stuff, and if they leave in their operating agreement that you as an LP are going to be expected to answer a capital call, like that's a big red flag for me. I think the GP should be the ones that are giving up equity if they underwrote something wrong. If I'm an LP, I shouldn't expect that my interest gets diluted because someone did bad math 3 years earlier. So that would be one thing I would look at is, and the operating agreement, what is an LP expected of if the deal goes a little south, or someone missed the mark on some of their targeted returns or targeted income of the building or the asset or whatever whatever the syndication is. That would be first to me, is if I'm expected, if the operating agreement leaves the door open that the manager can just make a capital call and dilute my interest if I don't want to participate, that isn't something I would be interested in coming aboard.
Yeah, and
Now,
I'd look at
to be
also.
clear,
Go ahead.
Sorry, to be clear, you're talking about capital calls aren't necessarily bad in and of themselves, but when they're to make up for some kind of deficiency that was unplanned for, right?
Right. I think a capital call that is an offer and not an obligation is much different. So, putting it out there that, hey, somebody else wants to participate in some new play or some new idea, but if math goes wrong and now I'm getting my interest diluted because I don't believe in the new story that's getting laid out, I just, for me, that doesn't seem like someone that's done all of the homework.
Yeah, that's when it's gone sideways. That's one outcome might come about it. So I think one thing before that is looking at the structure of, if the manager is not performing, what are the metrics to measure that, and what are the options if they're not meeting those metrics, if things aren't going as planned? How is a new manager named? What happens to the previous manager? If they have equity in the deal, what happens to that ownership? And then just a practical side is succession planning. What if that manager were to get in an accident, or disabled, or worse off, tragedy and death? What happens then? What kicks into place, and what plan do you have for those scenarios? So I think those are some basic, some fundamental questions, but they oftentimes get overlooked during the excitement of the investment and the offering and everything. Everybody obviously looks at the numbers and everything, but what happens if things don't go as planned is always something that you have to stop and think about.
And what would be the way to ask that question of about these contingencies down the road? How do you ask that? Because it's one thing to read the documents, but to get it verbally and to see their response is a little bit different, right?
Yeah.
In the operating agreement, they're going to have some section about removal of the manager, and so it's looking at what that section says. A lot of times, it's stuff like if you've committed crimes or misappropriated funds, or if you've done things to harm the reputation of the company. They're kind of usually broad in general operating agreements, but you want to take a look at that particular section. And then, yeah, same sort of thing. If that's removal, but then there should also be a section that talks about withdrawal or withdrawal of the manager and what happens in those scenarios. And, sorry, Paul, I
Yeah,
cut you
no,
off.
nope, that was it. So the easiest thing, if you're an LP and you're not really sure those things, is if you look at a lot of deals, just have your lawyer write an email that you can copy and paste and get answers to, and just ask for them to respond in red, or if they want to do it on Zoom. You can use the same questions over and over on all deals that you have going forward, just like the ones we just came up with right here on the spot. Like, hey, if you guys suck at your job, who's going to be on the hook for having to pay to fix the problem? And have them point to where you should look to firm up their point of view on, LPs aren't expected to contribute any additional capital to the deal unless they want to, sort of thing. So, just ask those questions and then wait for the email back, and don't participate if you don't get an email back. A lot of these things are pretty straightforward. People get excited. They might see a building with a great looking offering memo from the broker and really want to own that thing because it's down the street of where they had their honeymoon 28 years ago.
For example.
But this is, this should be emotionless as much as possible. So you're not chasing after a shiny penny that is, only a penny. What can you even do with that anymore anyway?
Well, to that point, then, what are some common mistakes that you see investors making, aside from those?
Yeah, I'll just hop in. Not asking questions, not knowing anything about the person that you're giving money to, not asking for any kind of success stories on their end or their partner's ends, like who's going to be running the deal. Have you ever run the deal before? What do you do for a living outside of this? Because a lot of folks don't do this 100% professionally. It's kind of like a tack on to whatever else they're doing day to day. Is this going to be your full-time thing? Do you want to invest money with someone that may not have, that has a W-2 all day, and then is going to be your asset manager or GP, from 5 p.m. till they go to bed? So those sort of things. Ask questions. Be curious. If you're fortunate enough to have a advisor on the financial side, make sure they're asking those questions for you before they earn their percentage.
Yeah.
But just be curious, I think, is a good rule of thumb.
Yeah, that specific questions about first of all, if they're a real estate team that this is their full-time gig, they have a full-time team or whatever. Like Paul said, some deals we see come across are folks that are doing either half-time or less or whatever. So that's important. And then just a specific question of how many hours a week do you have to devote to this particular property? How many other properties do you have? It's great if they have experience and they have a big portfolio, but if they have a big portfolio, do they have time and team to support that portfolio? And how often are you going to be at the actual property? Because as much as we have technology and things to help us be offsite, I do think that there's some definite value in to being there in person and on a regular basis, and presuming you're getting property management, managing the manager. Ultimately, the property doesn't belong to property management, and even if they're a great property management team, they're spread across other properties too, and you do have to kind of do some oversight of those third-party property managers.
Now, have you seen any really creative deal structures that that maybe be interesting to investors to think about as they move forward and they have these discussions?
There's a lot of seller finance these days, so people are carrying a note, like the seller is to get his or her purchase price. They're going to carry some of the purchase price at closing. That's probably the most differing than what we saw the last couple of years, because before, when lending was so cheap, 3 and 4% for commercial deals, sellers were getting pretty much whatever they were asking for, because, with your lending and debt on the deal being so low, you could ask for the sky. So seller carry is very common, but is about as complex as it gets. Otherwise, other things ends up being maybe like an equity carry. Someone is instead of doing a seller carry, they're coming as an equity owner. after the transaction. And those can get a little weird because a bank might not see that as an arm's length transaction. They may not want to do the lending on that sort of setup. So um, those are the two most common we probably see. Anything I'm missing, Adam?
No, I mean, what we tend to see and also kind of reinforce is deals that are put together in relatively straightforward structure wise and investment wise. I offeree has a deal. The offering party has a deal. You got to learn about the investor has to learn about the property, has to learn about the business plan, and has to learn about the expected returns. And the more curveballs you put into that learning equation, I think it makes it a little harder between the parties. It makes it harder for the person raising the money. We generally see. So creative's good, but sometimes it can work against everybody. But in terms of creativity, some people do the waterfalls that cap what the investors can get. In terms of if it reaches a return of maybe 14 or 16%, then the GPs are going to start making more money, or all the money beyond that return for investors, which kind of takes the fun out of it, right? It's kind of more fun for investors if we can go without that waterfall. So if there is a big upside, they're reaping the benefits alongside the GP. So yeah, not too much other than those sort of structures is what we're seeing right now.
Where do you find people sourcing deals most effectively?
I think a lot of people are going direct to seller, but I haven't really seen that work out as often as people attempt to do it. Sellers these days are wise enough. The internet is great for a whole number of reasons, but I think as much as anything, it's education of folks. So, not long ago, 5, 10 years ago, there definitely was a different commercial owner than there is today. Like, you can find anything you want about cap rates or anything if you're a commercial owner, where someone that might have taken over a property for their parent, 20 years ago, you can be so much more educated on what you can expect. So maybe 10 years ago, some guy down the street offered to buy your apartment complex or whatever, asset. It was harder to kind of get your arms around what the true value is. Now there's, so many different ways to figure out the value of your property. So I think direct to seller, unless you're either a big shop or a commercial broker, it's harder to get the ear of those sellers. So I think the best relationships are the commercial brokers. If you're lucky and you have a good transaction with an owner, sometimes you can piggyback off of that. We've seen, we've had clients that have closed a deal with a broker and then kept those relationships going with the seller and bought their future deals. So I think brokers are by far the top dog as far as finding deals. But some direct to seller. It just depends how you market yourself, So if you're an internet person that talks a lot about it, you will hear from people saying that they're interested in, hearing about what you could offer them so they can make it quick. They don't want to pay a broker. So.
Yeah, and I think there is definitely value to word of mouth, because ultimately I think it comes back to that buyers have a relationship with seller and or solve problems for seller. So I think the one sourcing deals isn't necessarily a mystery where you cold call a seller and that works out. It might end up working out, but it's over time. It's because you've spoken to them and they like you as a buyer, or you are the one kind of sourcing, I think, isn't exactly sourcing, but is a way of getting more opportunities, is being a problem solver for that seller. So understanding what the seller's needs, and then being able to be creative about how to address those needs, so you can find that common ground that makes the deal work for both of you, I think is ultimately like the best source. But better than cold calling just a mass number of strangers. I think it's communication over time with sellers and trying to be a problem solver for them.
I'm going to ask a question that's kind of a big one at least for me, because I don't know this side very well, but are there any legal issues that LPs need to be considering, thinking about, planning for, that aren't the common stuff that you'd normally think of?
I mean, traditionally, LP's risk is really how much capital they put into the deal. However, lawyers will go after anybody, whether or not they'll win or not. They will they will try to get after the purse of everybody. So, I mean, that's one thing. And anybody can tell you, oh, you're an LP. There's no way that, you can get sued for more than the capital in. I mean, that's just everybody can be sued for anything at any time. So that would be the one thing. If you're an LP, if you're on an ownership schedule, and if something really goes poorly, you will more than likely be a party to that lawsuit, just because if somebody gets injured on the property, they're underinsured. As an LP, you'll probably be named. You probably won't be on the hook for anything more, but you'll have to pay a lawyer to defend you and all that. So that's probably something that a lot of people don't think about. Is in this country, there are maybe not frivolous, but just a smidgen more than frivolous lawsuits filed every day, just to try to squeeze people out of cash. So that's just something to be mindful of.
Yeah. So if the individual name is on that ownership schedule, we recommend not doing that, because that's who's going to be named. So, having that investment LLC or whatever entity you decide on isn't a bad idea, just for that reason.
That's a good point.
Your name individually isn't out there in a lawsuit, which may be completely baseless, but that doesn't change the fact that it's out there, named in a lawsuit. So yeah,
that's a great suggestion. So, but I just want to close with any other suggestions or recommendations that you have for any investors who are considering investing in a real estate fund or a real estate syndication.
Yeah, if you should either know what the hell you're talking about, or you should have somebody like Matt that knows what they're looking for. You need somebody. It's a team sport. You shouldn't do it alone unless you've done this dozens of times. You won't even know what to ask. So it's whatever you're considering putting in. Remember that it's a significant amount of money, and you don't want to blow it. So either get a lawyer that's done this sort of thing before, so they can ask questions on your behalf and pay them the few bucks. Because if you're putting $100,000 in, wouldn't it be okay if you ended up paying a lawyer $2,000 to ask some questions on your behalf, and it turns out these guys were total clowns? So don't do anything on your own. Just because something was thrown in front of you and you have a few bucks, don't get overly excited. Have some dark cloud like me, Adam, or Matt rain on your parade, just to make sure that you're doing the right thing with your capital, or at least thinking about it more so than maybe you would otherwise by yourself.
Yeah, analysis paralysis is a real problem for sure.
Yep.
That's for sure. But it's also important to do the homework, to have somebody slamming on the brakes if necessary. You can't eliminate all risk, obviously, but you can certainly do what you can to limit it. And like Paul said, get a couple of pros on your team, and get their advice and take it seriously. Don't rush in because of the excitement, and everybody likes to go out and buy stuff, shopping. Everybody likes the excitement of investing in real estate. It's a cool looking building. Try to tamp that down as much as you can. Go for the boring stuff.
Yeah, Adam calls us pros. I call us wet blankets. But you do need somebody to sober you up, because not every deal is a great one just because they paid their marketing person to put a cool looking offering memo together.
And yeah, I mean, and you do, if you don't have to do all the homework. Maybe you're too busy to do it, but there is somebody needs to look through the numbers to see if they're legitimate. Shouldn't be news to anybody, but the real estate world's full of, I'll say, very optimistic real estate pros.
Fair, that's fair.
That's probably too fair. And a lot of their numbers are not just optimistic; they're beyond optimism. And so you need somebody. If you can't identify that yourself, you don't know what the standard expense ratio is and all those sort of things. That's okay. Find somebody who does.
Well, that's a great place to end. Thank you for your insight, your wisdom, all that you shared today, and we'll look forward to next time, whenever that is. Hopefully soon.
Yeah. Yes, sir. Thanks a lot.
Thanks, Matt. Thanks, everybody.
All right.